After an initial push lower, the TTF bears couldn't hold on to their progress and the market reintegrated into a sideways range. NBP front month is still firmly established in its sideways range, and the EUAs are both setting up a bullish continuation, a bearish reversal, and a sideways pattern. So, what's next? Let's have a look. Hi, my name is Marcello Kolax. I'm the Managing Director at Clever Markets. As always, everything you see here is just my personal opinion and not an invitation to trading, and also not trading advice. We start every week with our TTF sentiment benchmark, and here we see that after 3-4 weeks of sideways hesitation and an equal split of the bears and the bulls are now taking over. And that is probably because the market has bounced off the big important support level. This is our markets on Monday morning, and you can see that the TTF hourly chart is still bearish, and that's because it is still flowing lower within its descending channel. So once we break higher on the hourly chart, we can expect a significant up leg on the daily chart, but we really need to sit this out and wait for it to actually happen. Let's get started with the TTF front month. So here we see that the market has been moving sideways within 31 and 33.44 since late August, and the market has been respecting this boundary quite rigorously. So last Thursday, however, on the 13th of November, we did break briefly below the range. And at that time, even the Clever Markets team internally had a big discussion about like which way the market is most likely to go. Because here is what we saw, and I'm sure some of you saw exactly the same thing. So whenever we see that the market breaks past the really important level, we are looking for quite a few pointers to ensure that this is a valid break. What we first want to see is 2 consecutive closes below this important key level. So here we saw one big old red candle, but we were still waiting for a second red candle to truly confirm this break. Then what we wanted to see is high volume. We had okay volume, but it was nothing to write home about. It was just okay volume. Then what I also want to see is accelerating bearish momentum. So let's see what the market actually did. We did get a flow of lower lows and lower highs on the MACD, on the moving average convergence divergence, which is our momentum tool. So here this is still looking quite a bit bearish. Then we saw that the market has been pushing lower on the moving averages as well. We are looking at the 8 and 12 exponential moving average. So all things considered, this kind of looked like a really good setup for the bears. But at this point, it's worth zooming out a bit more. You can see this initial red candle found immediate support at 30.3, which is the lower boundary of this descending triangle that we've been working with since June. And this shows that the market has been pushing into an increasingly tighter range month after month after month, which was briefly interrupted by this rectangle range. And now we continued a little bit lower. So even if you're very bearish inclined from a fundamental perspective, waiting until a break below 30.3 was the recommendation to rule out a false break. Also, our own internal proprietary algorithms showed us that the market is still actually moving sideways, which increased chances of this just being a false break. And then on Friday, even though tools started to show this bearish tendency, we pushed higher again, immediately undoing the break we had on Thursday. And this was a very stark reminder for all the bears that the sideways range isn't over yet. And I genuinely thought, personally, we didn't write it anywhere, but personally, I thought that the market could push very easily below the 30.3. Luckily, our own proprietary algos prevented us from making this bearish call, and we simply stayed sideways because our regime index showed us that the market hasn't picked up on this bearish stance yet whatsoever. And you can see we are still anticipating the market to bounce higher and then maybe move within the 31 and 32.58 range. So these tinier swings are best traded on the hourly chart, not on the daily chart. And here we are still working with a descending channel. So we are bearish on the intraday chart within the descending channel, but we remain neutral on the daily chart within the rectangle. So how do we trade that? We would know that the market has for sure bounced if we start forming higher highs and higher lows on the hourly chart. So we need a break above the 31.58, which would also mean almost a break above the descending channel. If we break above this level, then we could make it all the way on the daily chart, first towards this descending triangle boundary near the 32 area, and then towards the 32.58, which is this peak here. So you can see the bullish confirmation on the hourly chart would simply mean sideways continuation, or like another swing sideways on the daily chart. So we can still take advantage of the hourly chart with a mean reversion strategy, but now is not the time to take any big directional positions on the daily chart. Now let me show you what the NBP front month is up to. So here we are also within a range of 75.37 and 87. And even within this range, we have started to build an even tighter range, which is best traded on the hourly chart. So overall, our proprietary algos are showing us that the forecast state is at 0 now, which means we are not trending anymore. And when we are not trending, our backtests have shown that the market is more likely to respect the established ranges. So here, this would be, in our case, within 79.41 and 82.63. And you can see last week also ended with not quite an evening star, because for that we would want to have to see a gap higher here on this middle candle. But it's definitely showing us that the bulls tried to push higher. They failed to hold on to their gains and then pushed lower with the next candle. So this overall, although it doesn't really qualify as a candle pattern, is still showing us that the market is more likely to go lower significantly. Now here's the thing, if you want a refresher on your candle patterns, then do have a look at clevermarkets.com. If you go to our free resources and the blog, you will see that we have the ultimate guide on candle patterns for European energy traders. So do check that out completely for free. Overall, at the start of this week, we do expect a weak open and a maintenance of this range. Now let's have a look at the German power markets. So here we are overall still within this ascending channel on the daily chart. And ascending channels simply mean that the market is swinging higher, the uptrend is healthy, but look at this. We could redraw the ascending channel in quite a few ways, but let's take this here for now. So you can see this ascending channel is potentially turning into a rising wedge. And rising wedges are usually eventually resolved to the downside. But also for now, I'm still very happy with the ascending channel. Both are equally fine. I just want you to be aware of the rising wedge option. Now, let's have a look at what has been happening over the past couple of days. So a week ago, we did get this potentially bullish setup. And what is that? So this here is called a falling three method, which simply means we have one strong green candle, then three smaller red candles contained within that range that do not push below this range. And then what we would have liked to see is another big green candle that simply continues the uptrend. So this is typically a bullish pattern because it's showing us that the bears had 3 attempts at pushing lower, but they couldn't quite make it, so the bulls continue. So this would have also meant an upside acceleration above the channel that has already been established. So that was last week what we expected. We expected more gains because tools still kind of aligned with that. But look at this. The bulls completely squandered that opportunity and the market has been pushing sideways ever since. Our proprietary algos are also showing us that the market is sideways. There is no bullish or bearish trend active right now. And here exactly the same, our backtests are showing us that if the regime index is determined to be neutral, then the market is more likely to respect the established range. So what is the established range? For that, we go on the hourly chart. It is not that clear yet. We expect the market to maybe push a little bit higher, but also down wouldn't be absolutely crazy. But now we are in a range finding process. And this could either be between 87.84 and 90.93, well, let's call it 91, or If this level here holds, then the range would be 87.84, 89.89. So we still kind of don't know how tight the range is going to be, but we are expecting a range market. So what do we do in this range market? First of all, let's ignore trend and momentum tools because they're really not useful in a sideways trend. Instead, we want to keep an eye on potential reversal candle patterns at these potential boundaries. We want to see them confirmed with oscillators in order to trade the smaller ranges with a mean reverting strategy. So here, once again, now is not the time to have a big opinion on the broader market direction. Now let's have a quick look at the EUAs. The one thing we definitely shouldn't forget that even though the market has been pushing higher for quite some time, it is all within the context of this rising wedge. And rising wedges are usually eventually resolved to the downside because it's showing us that the up legs are getting shorter and shorter. And right now we seem to have reached the peak near 82.41, which is where the market hesitated for the second time. So the big question is, what's next? We can see our preferred scenario is maybe a little bit more higher, maybe towards 84.44 potentially. But even if we make it up to here, the idea is still for the market to continue lower eventually. And the bulls would only be fully in charge below 78.91 on the daily chart, which is this trough, and would also mean a break below the rising wedge. So how do we trade this? Well, not on the daily chart. For that, we want to go into the lower level hourly chart. And here you can see we are dealing right now with a really well-established rising channel that has been in place since September, right? And you can see we no longer hit the upper end of the ascending channel, which is usually a sign of bullish exhaustion. What else is pointing towards bullish exhaustion? Well, we see that on the MACD, our momentum tool, we see that the peak has been lower, which means that the bullish momentum has been decreasing while the price is still pushing towards the same level. So lower MACD, but the price hitting another old peak means bearish divergence. So this could eventually lead to a move lower. What else are we looking at? We are looking at volume, and volume isn't really giving us any clear signals right now. So it's all over the place. It's stable. There's nothing crazy going on here. So there's not so many hints from volume. Then we start looking at the trend tools, which gave us a bearish crossover with the 8 exponential moving average crossing below the 12 exponential moving average last Friday, which is a bearish signal. We also saw that the MACD, by the way, crossed below the zero line, which is usually a bearish signal itself. So why are we still not fully bearish inclined ourselves? Why do we think that the market has a good chance at pushing at least a little bit higher before we continue lower? Well, this is because the 80.44 level seems to be holding quite nicely for now. It also seems to be this little minor trough here from the 11th of November. And we also saw that the week ended with a bullish signal on the oscillator. So we pushed above 20 on the slow stochastic. So this increases chances of the market starting bullish. We could maybe even push above this mini channel here before continuing lower, right? So the oscillator is showing us the immediate signal, and the trend and momentum tools are giving us the broader signal. Now, as you can see right now, we are still going. Is this like a teacup handle? Question mark. Because a cup with handle, so this here is the cup and this here is the handle, is still possible if you find support at 80.44 and if we push above 82.41, because this is a bullish chart pattern setup. It is just unconfirmed. So what do? If we get a close below 79, then this means that this here is turning into a double top, which is a very bearish pattern. And remember, on the daily chart, a move below 79 would also mean a move, a rising wedge, which is then a very strongly bearish trigger. The alternative is the cup with handle playing out with a move above 82.41. If 80.44 holds, then the bulls would continue to be in charge on the daily chart. The third alternative is if we find support somewhere at 79 or maybe 80.44, but you're also not pushing above 82.41, what you could then see is simply sideways continuation, which would be very painful for a lot of traders. But look at this. On the daily chart, also, there is a chance for this to turn into a sideways trend at least a little bit. You can see here the bulls are not in charge anymore on the momentum. Stochastic really isn't going anywhere on the daily chart either. So there is a chance for this like whole thing to just continue sideways. Now here's the thing. We cannot predict the markets, but we have right now very clearly spelled out what would mean a bullish trend above 82.41 and 80.44 holds, a bearish trend with bearish confirmation growing below 80.44 and then 79, or a neutral trend with this range holding. Isn't that brilliant? Because now we can start looking for trading opportunities at these key levels without having to pretend that we know what's going to happen next, because we really don't. As always, technical analysis is the best tool to keep us honest, to spot trends, to plan trades, and to manage risk, but it is not a forecasting tool that so many wish it to be. Once again, check out the free candlestick guide on our website. See you around, and bye bye.